while others still log in, can somebody tell me? I mean, for all those who've been watching the markets, I'm sure you can see that it's been a very volatile session, and the year, for that matter, has been volatile, and we've seen lots of movements up and down. Of course, more towards the downside. So it would be nice if some of y'all could just use your chat box and let me know what, according to you, were the factors that contributed to the sell-off in the markets. Like maybe just one or two words. Like what do you think? Why have markets been down this year? We've seen SPX fall by almost more than 20%. When markets fall by more than 20% from their highs, it is generally considered as bear markets. So use your chat box. Okay, well, someone says rate hikes, perfect. That's one of the reasons. And what are rate hikes? Why are central banks going for rate hikes? What is the reason and the factor responsible for rate hikes? Because that is the prime reason why we've seen the sell-off in the markets that we have. So rate hikes is definitely the prime factor. But what led to these rate hikes? Yes, amazing. It's glad to have such a aware and well-known audience. We've had inflation, which has been a problem, because of which we've seen multiple rate hikes. So yes, like you all have stated, this year markets have been down and we've seen a lot of volatility, and some of the factors which contributed to the same were obviously valuations were already high at the start of the year. We had a lot of geopolitical tensions. All of us saw what happened between Russia and Ukraine, and because of that, we actually saw inflation, which was already scaling high, increase further because of supply chain issues, Russia-Ukraine issues, and then we had further lockdowns in China, which aggravated the supply-related problems. Now, to tackle inflation, we had central banks across the globe who started adopting a more aggressive policy, and they've started increasing their rate hikes, and they've also started sucking out the liquidity from the markets. So all of that has contributed to a sell-off in the markets, because obviously when the central bank will go for rate hikes, that would mean treasury yields will go up. When treasury yields go up, we will see a sell-off in stocks, because increase in rates also means that it would get difficult for banks to borrow, and not for banks, I mean corporates to borrow. The lending rates will go up, so borrowing charges will increase. That would take a hit on their profits, and because of that, we have recession fears in the market, and that has led to the extreme sell-off that we've seen this year. All right, so now that we've seen the sell-off, and there is a lot of scare in the market out there, the next question is that what do we do in such markets? How do we participate in such markets? So this is what we will be covering in today's session. Now, one of the ideas that you can, that could really be of great help in the current markets would be something known as market neutral strategy. Now, as the name implies, it is market neutral. That means it does not care about what is happening in the market. So take, for example, I mean, we have this chart over here that you can see, which basically describes what, like on this end of the curve, you'll see there is more market risk. And as and when you climb up, you'll see there's more security specific risk. Now, when we say market risk, let's cover this point. For example, passive equities. What is passive equities? It's like a passive approach wherein you're investing, say, in the S&P 500 and not doing anything else, just investing in the S&P 500. So does that mean you have zero market risk? No. Even if you are, there is a misconception that if you're investing in the S&P 500, you do not have any risk. No, you have a lot of market risk out there, because ultimately you're investing in the market. You're investing in the S&P 500, okay? But in this particular situation, a security specific risk is very limited. So you are not investing directly in one particular company. When you're not investing in one particular company, your risk is not related to that particular company. So no matter if for example you invest in a particular stock, say if you invest in Amazon. Now if Amazon's profits take a huge hit, or if there is a slowdown in the discretionary sector, and if Amazon is going through probably there's a legal complication, there are some case that is filed on Amazon. So if Amazon is going through issues and you invested in Amazon, then you are heavily facing a single security specific risk. So if the if there is any case on Amazon, you will probably lose out and the stock will fall. But if you are investing in S&P 500, even if there is some problem with Amazon, the impact on your investments will be very limited, because you are investing in the entire universe of 500 stocks that are included as a part of the S&P 500. So when you have a passive equity investment, your security specific risk is low, but your market risk is almost, I mean, it's pretty high. Now, take the other example wherein you're investing in active equities. That is, you're investing in Amazon, you're investing in Microsoft, you're investing in 10 other stocks. Okay, you've done your research, you've shortlisted 10 companies that you think are good investments. So, in this case, not only do you have market risk, but you also have security specific risk. Because if one company reports lower profits, obviously your stock will fall, and that could result in losses. But at the same time, even if there is a situation in the markets which cause the markets to tank, that will also have an impact on your stocks. Like we've seen this year, S&P 500 is down because of inflation and because of various other reasons, and that has also been a drag on multiple equities in the market. So this is passive equities, wherein we saw there's less equity specific risk, but more market risk. Then we have active equities, where there is equity specific risk as well as market risk. Now fast forward and come up to equity market neutral. Now what is this about? Now when we look at equity market neutral strategy, what this strategy talks about is that there will be very limited or close to zero market risk, but more equity specific risk. So when we look at equity market neutral strategies, obviously we'll discuss this in more detail. It is basically you're invested in either two or three relatable securities, or maybe commodities that have high correlation, and your risk is specifically tied to those particular securities. No matter if the market goes up or if the market goes down, your risk is just tied to the relationship between these two equities. So we will be talking about this in more detail, and that is what majority of our session for today will cover. We will be seeing what is market neutral and how can one participate in the same. Now, before I explain this further, I would really like you to let me know. I'll just start a poll basically. 1 second, to see how many of you know what is short selling. Okay. This is very important. Please answer the poll, because on if short selling is very important and critical to market neutral strategies. So for all of you who know this, only then we can move forward with the session. So I really would appreciate if you respond. All right, I'll wait for another 10 seconds. It's great. People have been responding. Okay, it's almost divided. We have 50-50, where some are saying that they are aware, while others are not. Just another 5 seconds. 5, 4, 3, 2, 1. All right. So yeah, the ratio is almost divided. So I'll quickly explain as to what is short selling. So what we see in a normal situation is generally we'll always, if we are expecting the markets to move up, we will buy here, and probably once markets move up, then you'll sell at the higher end. Short selling is almost the other way around. So, if, for example, what if you are expecting the markets to fall? So, you're already over here and you're expecting the markets to come down. So, in this case, we'll be doing exactly the opposite. That means you'll be selling first and then buying later. Now, how is that possible? How can you sell something that you don't even own? Uh, that is what is a short selling, and I'll explain it to you as to how it can be done. One second, let me just give you a quick example. So, yeah. Just take an example. Suppose iPhone has come out with its, brand new version of iPhone, and we are in September, for example. That's the time when iPhone actually comes out with its new iPhone every year. So you have a friend who's in US and who brings with himself, say two iPhones. One is for himself and one is for his wife, whose birthday is in January. So he's just bought an iPhone from US for her. Now, assume that because of COVID or because of any reason, there is, a shortage of flights, and we do not have much supply of iPhones in the UAE. So the demand for, obviously, iPhone is crazy, and people are willing to pay a higher price for it, and so on and so forth. So suppose the current price for iPhone has gone up to almost 8,000 dirhams. Now, you look at this as an opportunity. You go up to your friend and you ask him, "Can I borrow your iPhone? And I'll give it to you back before your wife's birthday." A brand new iPhone in the box. You need not be worried. And since your friend knows you and he trusts you, so he's like, "Okay, I don't mind giving you an iPhone." Now, you take that iPhone from your friend and you go and sell it in the market. All right. So now what will happen when you sell this in the market? You sell it for 8,000. So 8,000 will now come into your bank account. So you sell the stock for 8,000. One second. Yes. All right. So in your account, you have 8,000 dirhams. Now, 2, 3 months later, when you see that flights have opened up, cargo shipments are normal, and the demand for iPhone is also lower, and now you see that the prices for iPhone are back down to 5,000. So, what would you do in this case? Uh, all right. Can you? Someone said that the screen is blank. Can you now see what I'm typing? Can you see 8,000 on the screen? A thumbs up by anyone or a response would be great. Can you see what's mentioned? Right, perfect. So we would have received 8,000 in our bank account, and now you basically see iPhone prices have dropped again. So you go and buy it from the market for 5,000. Okay, you buy this iPhone for 5,000 and you go and give it back to your friend. So what happened in the process? In the process, you received 8,000 and you paid 5,000. So $3,000 is what you gained. This is how short selling also works in the financial world. I'm just giving you a layman example for your understanding. You will basically borrow the security from your broker, sell it, and then when prices fall down, buy it again and return it to your broker. This is how it works in the financial world. Just for your understanding, this is, you don't actually borrow from your broker, but that's how the concept works. So I will also show you a demo account, so it will be easier for you to understand. One second, I'll just share my screen. So this is how a demo account looks like. Okay, before we move ahead, come on, I would want you all to tell me what's one stock that comes to your head that you think we should sell right now? I'm waiting for responses. Anything, any US related stock for that matter. Okay, all right. I think Tesla is like a hot favorite, either on the buy side or on the sell side. People are always talking about Tesla. Well, okay. So since majority of y'all have mentioned Tesla, we'll look at Tesla at out here as well. So it's very easy. You can just type the name of the company, and like you can see here we have Tesla. I can click on it. Now, if I want to sell Tesla, if I want to, okay, let's first understand if you want to buy Tesla, right? So if you want to buy Tesla, you enter the number of units that you want to buy. So this is a demo account wherein I have $100,000 in my account, and if you want to buy Tesla, you enter the number of units that you want to buy. Say if I want to buy 100 units, that would cost me $65,000. I have 100,000 in my $100,000 in my account. I can easily go ahead and buy 100 units of Tesla. In fact, I can buy way more than that. But in this case, we want to sell Tesla. So if the minute I click on this button out here, it turns yellow. That means you're on the sell side. So say if you believe Tesla will not do well and you want to sell 10 units of Tesla. Okay, so 10 units of Tesla will cost you how much? It will cost you 10 into 652, which is $6,500 approximately. You will sell Tesla, and if the prices come down, then you can buy. So I just enter the order over here, place sell market order, and yes, my trade is taken. You can see over here in my positions, we've sold Tesla for 652, and right now it is in a loss. Once prices start coming down, then probably we'll start making money. So as and when Tesla prices fall, this could be a profitable trade. Okay. Now coming back to our session. Right. So this is how short selling works. I hope it's clear for you. Now why is short selling important? Short selling is important for market neutral strategies because market neutral strategies is something that we will see over here. We speak about pair trading. Now, what is pair trading? Pair trading basically involves simultaneously buying one unit or buying one security and selling another security. And these two securities are generally correlated. That means they will move most likely in the same direction. So what do I when I say security, it could either be two shares or it could be two commodities, anything for that matter, anything that is correlated. Let's take an example again. Let's so when I say the name Pepsi, okay, which is the other company that comes to your mind? Come on, get back to your chat boxes and respond. When I take the name Pepsi, what is the company that comes to your mind? So you'll be surprised to see, how everyone actually thinks in the same direction. Right. Okay. Great. I can see responses. Um, Please feel free to ask anything. All your questions will come directly to me. And also, while you're watching the presentation, if you want to zoom into any slide, you can do that if you're watching it on your laptops or your PCs. There's an icon on the right hand side which says that you can switch to full screen. So that is an option. If you're seeing it on your mobile phones, if you're attending through your mobile, you can just zoom into the presentation if any slide is not clear. All right. Yes. Okay. So we've seen responses over here. I'll just wait for another 5 seconds until people respond. Um, yeah, isn't it surprising to see how everybody just thinks in the same direction? The name that we have over here is Coca-Cola, right? Um, uh, in all odds, someone did even say thumbs up, but most responses were Coca-Cola. So now, Coca Cola and Thumbs Up are two companies which belong to the same industry. They will be impacted, they most likely will have a similar target audience. They will be impacted by the similar rules and regulations. So, more or less, if what you'll see, the prices for these two stocks will also move in the same direction. Either they'll go up in the same direction or they'll go down in the same direction. So, when we say pair trading or market neutral strategies, what exactly we are trying to do over here is that we are trying to play or capitalize on either the divergence between these two stocks or the convergence between these two stocks. So, if they trade in a particular spread, like if this is supposed to be the distance between, generally on an average they trade in this gap, like if Coca-Cola and Pepsi are trading at this level, if the gap or the prices between these two increase for some reason, then there is an opportunity over here where you can short one and long the other one and expect them to come back together again. uh, Let me take another example. When I say the name Mastercard, which is the company that comes to your head? When I say Mastercard, what is the other name that comes to your head? Again, get back to your chat boxes. Let's try and make this as interactive, because that's how it will be a great learning experience for you, and we'll be able to bring out the best of this session. Right, exactly. Perfect. So we have responses where everybody is saying Visa, right? Both of these belong to the same industry. If the economy is going through a credit crisis, or if there's a situation where people are not able to repay their loans, most likely both Visa and Mastercard would face the consequences. On the other hand, if probably and the economy is in a very good shape, and their people are using and switching over to credit cards in the long run, like we can see, it's the shift is happening towards digital economy. We can see that both Visa and Mastercard will benefit. It won't be a situation that one stock will move up by 20-30% and the other stock will remain there, unless and until, of course, if the company is doing something very differently. But since both belong to the same industry, obviously, if Visa is doing something way better than Mastercard, then probably Mastercard will also understand that this is a strategy that is working, and it will come up with the same approach, and probably see its stock price rise. So when we are talking about Visa and Mastercard, or Pepsi and Coca-Cola, like let me take another example. So we saw for Coca-Cola, there was some time back, there was this ad. I mean, not an ad. There was an interview where Ronaldo actually moved aside the Coca-Cola bottle and switched over to water. So when that happened, basically on that particular day, we saw Coca-Cola prices, move down to literally 4%, whereas Pepsi, on the other hand, stayed there itself. Now that gives a trading opportunity, because eventually, if Coca-Cola is down, that was a short-term, short sell-off. Eventually, we saw Pepsi prices also come down. So how is this an opportunity? You will short sell Pepsi because you're expecting Pepsi to come down to its average, whereas you're expecting Coca-Cola to move back up towards the average. So in the long run, both of these commodities will more or less trade in the same spread. So there is a lot of this is obviously the easy explanation for all that I've said out here. There's a lot of statistical analysis that goes behind the same. We look at the standard deviation, we look at the Z score of correlated commodities or securities, and then we come up with a decision if probably there is any trading opportunity or not. So there's a lot of analysis that goes into the same. Now, does this mean that this will always be a profitable situation and it cannot go into losses? Well, obviously not. Um, so for example, if we are into a situation wherein we've bought one company and sold another company for a particular reason, but going forward, let's take for example BlackBerry and Samsung. Now BlackBerry obviously went out of business. So when BlackBerry went out of business, obviously the correlation between those two stocks will not hold, and probably the stocks will never converge. I mean, will never converge, and the divergence will always remain high. In that particular situation, it would result in losses. So it's very important that we monitor our trades, and we keep the required stop loss that is required whenever we are taking these pair trading trades. Now, like I said, this is not only limited to the equity world. We also look at, I mean, to respective stocks, we also look at indices, we also look at commodities. I will be sharing an example of a commodity right out here on our next slide. But before that, we'll also look at what is how we can look at two stocks on our demo session once again. So I'll just share my screen. All right. So yes, we were short on Tesla by 10 units. Tesla has actually gone up. If you can see, the price is now close to 655. So because Tesla has gone up to 655, we are now at a loss. We sold it at 652, but now you're getting a better price to sell it at 655. So currently you're at a loss. Now coming back to our trades that I was talking about, let's look at Pepsi. This is Pepsi, and let's look at Coca-Cola. Give me a minute. Yes. So we have Pepsi and Coca-Cola. Like you can see over here, today Coca-Cola is down by almost 0.9%, whereas Pepsi is down only by 0.25%. So now this gives us an opportunity. Let me just give me a minute, sorry. Yeah, all right. So like we can see today, Coca-Cola is down by 0.85%, whereas Pepsi is down by 0.2%. So this could actually give us an opportunity that probably we go long on Pepsi and buy Pepsi. So we need to ensure that we are taking the same dollar amount of investment. So if I buy 10,000 worth Pepsi, or even 100,000 worth Pepsi, at the same time, I will be we need to take the trade the other way around. Coca-Cola is down by a bigger margin, so we need to buy Coca-Cola, and we'll buy worth $100,000. And at the same time, we'll sell Pepsi worth $100,000. So let me just take this trade out here. This is Coca-Cola. I have bought worth 100,000. I place the buy market order, At the same time, I'm taking a sell trade on Pepsi worth $100,000. That's it. It's so simple, and we enter. Now, so like you can see over here, we have bought Coca-Cola because it is down by a bigger margin, and at the same time we've sold Pepsi. Now we'll wait for some time. Now obviously you cannot, this is just based on a short-term trade, just that Coca-Cola is down by 1% and Pepsi is down only by 0.2%. It doesn't work like this in the real world. We cannot be taking trades just on this parameter. We have to look at uh, the standard deviation and so on, the Z score. All of these parameters and factors are taken into consideration. So all of that has to be taken into account before we take the trade. But it is important to understand what we are trying to explain over here. So you've bought one and you've sold one. So most likely you will be hedged and your risk would be limited in the markets. So that is what we are trying to explain over here. So we are buy on one and we are short on the other one. So even if the markets fall by a major percentage, what will happen is that the one that you are short on, that stock will probably fall, and the stock that you are long on will probably go up. So because you're short on one stock, you'll be making money, and because you're long on the other stock, you'll be losing money. So net net, your loss would be limited, and that is what is market neutral strategy. So no matter if the market goes up or if the market goes down, you are just playing on the divergence or the convergence of these two particular companies. Okay, that is what market neutral strategy is all about. Now, another market neutral strategy that we had worked out on was something called as Brent WTI spread. Now, Brent and WTI, for all those who are not aware, are two different qualities of crude oil. Now, since both of them are crude oils, obviously, when the demand for crude goes up, both these products will go up, and when the demand for crude oil is down, both these securities or the commodities will fall. Now, I'll allow me to share the flyer. So I just wanted to show you the trade once again. Like you can see over here, the trade is now on one particular stock, you're making money. So we bought Coca-Cola, we are making money. On the other hand, we are short Pepsi, so we are losing money out here. Now, it's very important that you keep in mind, most times what we see is many clients will, just because this particular trade is in the green, they'll just end up closing this trade. This is not how pair trading works. This is not how market neutral strategy works. It's important that when you close both the trades at the same time. And actually, we'll be closing it at a time when Coca-Cola, I mean, when your profits are more than the loss in the other particular instrument. So when we see the profits in either of these trades, when that is higher than the loss in the other one, that is when we'll close the trade, not otherwise. All right, looks like Tesla is also falling, and we have some gains over here. So we'll wait and monitor it throughout the session. In the meantime, I'll come back to the other slide that I want to share. All right. So this is Brent and WTI spread trade. Now, Brent and WTI are, like I said, they are two qualities of oil. So obviously, if the demand for crude oil will go up, most likely both will go up. If the demand for crude oil falls, most likely both will fall. So the what we look out over here is that generally, on an average, historically, when we've seen, this is basically the spread chart. That means the difference between Brent and WTI. So generally, what we've seen, Brent generally trades at a premium to WTI, and on an average, we've seen the premium has been $6 to $7. The maximum that it has gone to is $11, as you can see in the chart. Whereas on the lower side, it has been near $0, like minus zero point 0.5 and minus 0.16. So this is a strategy wherein basically what you're trying to capitalize on is the fact that when the spread is near the lower end of uh, you know the average, that is when you take the trade. So you're expecting Brent prices to outperform WTI. On the other hand, when the spread is very high, you would expect the spread to narrow, and at that point in time, you would expect Brent to underperform WTI. So say for example, when the trade was given at that point in time, this oil prices were at 82.5, and this was Brent June contract, whereas this is WTI May contract where the spread was $80. This flyer was actually released in January. We also had another flyer which was released in May recently, where the spread was again close to $2.2. But this strategy was released in January. Now, at that point in time, WTI prices were 82 and 80. The difference was only $2.2. And when the difference was $2.2, it was an opportunity to take the trade because it was at the lower end of the curve. As you can see, when the spread is close to $2, between $0 to $2, we see this as an opportunity that once it goes back up to $4 to $5, it could, result in profits. So, well, that actually happened. Let me just show you another chart. Um, Second. Just a second. Sorry, just give me a minute. Just a minute. I'm so sorry about this. Yes, right. Yes, so like I was saying, the spread was shared when it was close to 2.2. And as you can see over here, the spread actually went up to almost $6. This is the Brent WTI chart. So as you can see, in the start of Jan, it was close to $2.2, and it actually went up to $6 before correcting again to close to $0, again implying a new trading opportunity when it was close to $0. So this is basically market neutral strategy wherein you're getting an opportunity to enter the market when the spread between the two commodities is really narrow, expecting it to go up again. And at the same time, when the spread is really high, you expect them to contract. So you will be taking another trade. Now, like we saw on the slide, as I showed you, the spread was $2.2, wherein we took the entry, it went up to 6, giving you an opportunity to exit. And at the same time, when it comes back down to close to $0, there's again an entry opportunity. So there were clients who took the trade when the spread came down. Like I said, this is the chart that you saw on the other slide that I shared. So the spread was close to 0.09, and this provides an opportunity on the futures. When the spread was close to zero point 0.5, it was an entry opportunity, like you can see out here. The spread between these two was 0.5, giving you an opportunity to enter. And once it went up back to 3.5, you have almost an expected return of 3%, which gives you an annualized return of 10%, because you can make this kind of return in a period of less than 2 months. So we are basically not bothered about where oil prices can go. They can go high, they can go low, no matter where they go. We are just trying to benefit on the spread between the two. So like you can see, initially in the start of Jan, oil prices were close to 82. And out here, oil prices are almost 108 when this was shared previously. It's now 112. So, and the spread is already 2.2, giving you a great opportunity to already exit your trade. So, this is how it works when it comes to market neutral strategies. Now, another idea where we can capitalize on market neutral strategies, or which is really done a lot in the financial world, is something called as calendar spread. So when we talk about calendar spreads, it is important for you all to know what are futures contract. So again, I would like to know from you all as to how many of you know what are futures. I've just shared the poll. It would be nice if you could respond. Yes, I'll wait for another 10-12 seconds till the time we receive a response. Okay, well, majority of them say that they do know what are futures, which is perfect. For the ones who don't, I'll quickly just share the screen for you to see what are futures. Futures, it's nothing but a contract wherein you agree to sell a particular asset at a future date at a specified price and for a particular quantity. So everything is fixed well in advance. Basically, this was invented back in the day for example, for farmers who would, cultivate and harvest the crop. But when it came to selling at that point in time, when the crops were harvested, you did not know what the price of that particular commodity would be. So then a farmer would basically enter into a contract to sell their particular crop at a particular specified price. So no matter if the prices of wheat, say a farmer is producing wheat, now by the time the crop is ready to be sold, what if wheat prices fall? So here your risk is limited. You agree to sell wheat at a particular price in the future, no matter where wheat prices are. So you've locked in your prices. This is basically futures are used as a hedging strategy as well. Now, how are futures prices decided? How do you decide at what price will you sell? So generally, it's based on the kind of interest that is there in the market currently. So for someone who's actually postponing to make his purchases at a future date, he is basically when he's postponing, he's not investing that money currently. So he's basically not investing his money, and rather investing his money elsewhere in the bank, and he's getting an opportunity to earn interest on it. So most likely future prices are based on either your interest rates plus your storage costs, because the other person who's postponing his purchases to a future date, he's not even going to pay for the storage costs. So that's how future prices are generally decided. Now when there is a mispricing, when your holding cost, that means the interest cost plus the warehouse cost, uh, added to your current cash prices, if it does not add up to what a future price should be, that actually gives in again a trading opportunity, wherein you can sell the future product. If it's trading obviously at a higher price, you sell the futures, buy the spot contract, and again expect the two to converge. So and generally towards the expiry, what happens is that the futures as well as the spot contract will generally trade at par. That is what happens in the financial world. Obviously there is no guarantee about it, but most often than not, we see the two prices converge. So this is how it works in the financial world, and again, it gives an opportunity to trade. Now, so sorry once again. Yes. Coming back to the presentation. Um, Now we don't have any calendar spread which is currently active, but previously there was one spread that was active, which was something called as gold spot and futures. So gold spot was trading at, say, at a particular price, whereas the spot futures was trading at a higher price. Now, after considering the holding cost and the transaction cost, we realized that there is an opportunity in the trade because there was a mispricing out there. So that is how calendar spreads generally work. So what happens, like you can see out here, so give me a minute. Yeah, as you can see out here, we have gold cash, which was trading at that point in time, gold prices were really high. So it was trading at 2062, whereas the futures contract was trading at 2068. So that gives a spread of $6. Now, after you consider the holding cost and all other parameters, there was an opportunity that if the spread converges back to zero, that means at expiry, either both of them are 2065, or either both spot and futures contract are at 2068 or 2070, or either both of them are at 2062, whatever. Like both the prices need to be at similar levels. If that happens, this could be an opportunity to make almost 14% on an annualized basis. You would earn almost say 0.5%, but that would be in a span of a really short number of days, maybe less than a month, wherein you could earn 1%. So this is something that are called as calendar spreads and are a great opportunity in the markets. Some time back, we had Euro USD calendar spread, which was available currently because the interest rates in the United States have gone up. So this opportunity has slightly reduced, and you're not making that kind of. The opportunity is not as great as it was a few days back. So these are some of the ideas that are available in the current market situations. Then we also have one strategy which speaks about a pair trade situation between two indices. Allow me to share the screen once again. Right. So can you see out here? We have Swiss row. Um, okay. Sorry, just a second. All right. Yeah. So we have Switzerland and Euro 50 index. Now these are two indices. Now when it comes to Switzerland, this is an index that is heavily focused towards more defensive stocks. When I say defensive stocks, it means stocks that do not witness a significant volatility or a significant sell off as we see in the general market, especially during recessionary times. So, when you have sectors such as healthcare or consumer staples, these sectors, if you can see for Switzerland, the weightage for these two particular sectors is close to 60%. So, when there is a sell off in the market, especially during recessionary fears in the market, healthcare and consumer staples are such sectors which do not end up witnessing as much losses as the other sectors, for the obvious reason that obviously even if there's a recession, you cannot not go to the grocery store and you cannot not shop. Or for example, if you have health issues, you will go to your for your healthcare supplements irrespective of a recession. That is something that probably you cannot afford to sacrifice. But when it comes to discretionary items, that is where consumers can afford to cut down. So one sector that can take a hit when there is a recessionary situation could be consumer discretionary sector, or we could even see growth companies such as technology sectors that take a major hit, because obviously when yields go up, we generally see growth stocks witnessing a lot of sell off. As we've seen this year, Nasdaq is down by almost more than 30%. Now, the reason why this happens is because, sorry, one second, yeah. The reason why this happens is because when most of these growth companies and technology companies have a lot of your profits tied to the future, okay, and when yields go up, that means the borrowing cost goes up. So investors generally switch from the stock markets to the bond markets, because obviously bonds are paying you a higher interest at this point in time. So it becomes even more difficult for technology companies or for growth companies to justify themselves, because a lot of their profits are tied to the future. And generally, when you discount those profits back to current date based on the higher interest rates, the valuation of technology stocks tend to fall, or for growth stocks tend to fall. Now, keeping that in mind, technology stocks tend to underperform when we have a recessionary situation or when we see yields climbing up very quickly. So, in that particular situation, what we see is that technology stocks, or for that matter, cyclical stocks such as consumer, the financial stocks, or you have materials, or you have the industrials. These are sectors that tend to not do well during when the economy is going through a downturn, and there's a cycle for downturn. So if you see 28% over here, then you have 11.8%, you have 12%, and again 11%. So almost 50 to 60, more than 60% of your stocks out here are prone to witnessing further losses, I can say, compared to Switzerland, which over here has almost 60% coming from consumer staples and healthcare, which is the defensive sector. So when you have one index which has more weightage towards defensive stocks, and the other one which has more weightage towards cyclical stocks, which can be prone to basically it will underperform compared to another index. in an economy which is actually expected to go through downturn. So what we are betting over here, we are not bothered where do the prices go. What we are betting over here is that Switzerland will outperform Euro 50 if the economy is going through a downturn. If there is a cyclical downturn, if there is a recessionary situation, then Switzerland will most likely outperform Euro 50. So that is one way that you can participate in that one can participate in the markets in the current situation if he or she foresees a recessionary situation. So that is another idea. Now, apart from that, it's important that we consider, you know, even if we are not resorting to all of these strategies, and if we are a believer of buying the dips in the markets, so it's important that we diversify our allocation and are not invested in one particular sector. So it's important that you have diversified. For all of those who've not seen our previous sessions, we've spoken about blue chip ladder portfolio, even about index ladder portfolio, where we are basically saying that you need not invest 100% of your proportion at one go. You rather invest in phases wherein you're actually capitalizing on any downfall in the markets, and you're not risking losing all your money at one go by entering at the peak, because if there's more sell off left, then you rather invest in phases. So currently the market situation is such that stocks have fallen down, giving many investors an opportunity to enter, but we don't know if there is more sell off left. And to avoid further losses, you probably enter in phases wherein you get to average at better level. It's also called as dollar cost averaging for those who do not want to actually invest in a particular stock. Can go for the index ladder portfolio, or we could even consider the SIP form of investments. As we've seen previously, a mere $1,000 investment in SIP would have actually grown to 3.25 million in the last 40 years. So if you started investing since 1988, we could have actually grown to almost $3.25 million dollars, just $1,000 every month. So SIP form of investments can be one strategy that you can consider in the current markets, wherein you invest in a fixed proportion every month, irrespective of where the markets are. Or even if you're going for a dollar cost strategy or any other strategy, one thing to keep in mind is to avoid using excess leverage in these markets, and because obviously markets are very volatile. The up moves or the down moves can be very drastic. So avoid using excess leverage. Clearly avoid going for penny stocks. It's important that we stick to blue chip companies, quality companies. We've already shared our blue chip ladder portfolio. In case if you want it and if you're interested in the same, you can reach out to your respective RMs. They shall share it with you. And in case if you want a one-on-one session to understand market neutral strategies or pair neutral, pair trading in detail, or even about our blue chip ladder portfolio or our index ladder portfolio, you can get in touch with us, and we shall, we are happy to help you and provide a one-on-one session as well. So this is it from my end for today. Before I end, actually, since we are here on the index ladder portfolio, it basically talks about investing across different indices, and ensures that your risk is not skewed towards one particular index. So it does not focus on just the United States or a particular index in the United States. So the benefit is that you have a diverse geographical exposure, which will help you limit your losses. So until last week, when SPX and all other indices were trading at a loss of more than 15%, UK 100 was at a loss of just 3%. So In fact, at one point in time, for the year, it was not even in any amount of loss. So it helps to balance your portfolio, and it does not give you that kind of loss if you had invested heavily in just one particular index. That's what they say. Do not invest all your eggs in one basket, because if that one basket goes down, then probably you'll face huge amount of losses. So it's important to diversify, and this is what your diversification can look like if you invest in the index ladder portfolio. It's important that we diversify across the globe. Also, well, like in the current markets, having a diversification between equities as well as bonds is also necessary. Besides, you can also diversify your portfolio towards market neutral strategies. So it's important that you take a diversified approach in the current markets. We also have a municipal bond portfolio out there, so you can get in touch again with your RMs to explain you about the same, or in touch with me, and we can have a one-on-one session. Always happy to help and be of any use if required. Yes, so that's it from our end today. If you have any questions, then please feel free to ask. Otherwise, we can wrap today's session. All right. Well, great. It's nice that you found the session educative. Thank you so much. Century Financial is always available for any queries or any request or any understanding that you require about the markets. Our sole motto and goal is to create as much awareness as required. In fact, previously we used to do a lot of seminars as well, but because of COVID situations, we now do a lot of webinars. So thank you once again. If you need any further help, any further questions, feel free to ask, or else we'll wrap today's session up. Those of you who are still here, I just happened to look at our at the trades that we had taken, and I thought I should just share it once again with you all. So if you can see, currently the pair trade is giving us profits, wherein Coca-Cola is giving us a profit of $389, whereas in fact now $400, whereas Pepsi is giving us a loss of $260. So net the trade is giving a profit of plus $150. On the other hand, Tesla is also down, and it's giving us a profit of almost $80 right now. So yes, these were some of the trades that we took in today's session. Yes, for all of those who were still there, I just thought I could just share it with you. All right, thank you once again. This is Deepa Sachanandani. If you need any further help, please feel free to get in touch with your RM or me, and we can help solve any of your queries. Thank you.